Hey everyone, this is Brent from Wolf on Wall Street Trade. Happy New Year. I hope it's going well for you. We've had a different start to 2025 than 2024. No Santa Claus rally, a little bit rougher start, but we've had a lot of stuff happen just in the last few months. Fed pivot, election over here, another Fed pivot within a couple months, and all this stuff's going to affect the near term and into 2025 most likely. So let's take a look at some things going on. I'm going to pull you back to July of 2024 when the NASDAQ sold off almost 16%. This was around the time I had posted this video, Stranger Signals, on July 14th. All kinds of weird volatility signals that suggested something like this was coming. So NASDAQ come down to the 200-day moving average, almost 16% loss, and kind of recouped that into the end of the year, which is an important theme too that we'll get to. One of the things that we've been noticing was that there was some selling in 3C. This is 3C, by the way, in orange money flow, proprietary money flow indicator. We saw some selling going into that July period, but what I've really noticed is since then, not so much like distribution, but just not a lot of commitment from traders on the long side. I would call it like opportunistic selling. So when we get bounces and stuff, they would take some profits, but not real heavy distribution. But still, you can see the change in character here between 3C confirming, even positively divergent here, negatively here, and just kind of lackadaisical over here with a relative negative divergence. My quick takeaway on that is profits that were made the first half of the year. It was kind of like play it safe and run out the clock, try to get to the end of the year. Hedge funds, of course, can collect on their management fees if the market closes up as high as they can by the end of the year. There's also window dressing, the election. We'll get to some of that stuff too. And here's the election where we did get a big change in character. What we're looking at is the S&P 500 and small caps. Here's the election where President-elect Trump won, and you can see small caps just really soar. So small caps are more of a pro-growth, early cyclical economic cycle group that you want to buy, usually not towards the end of an economic cycle or late in the economic cycle. So this reflects hope for pro-growth policies. So we saw cyclicals do well here, value stocks do well here, small caps, mid caps. But this whole election kind of knee-jerk thing didn't last really too long as we started getting to the end of the year and end-of-year dynamics. Here's where we start getting into those end-of-year dynamics. I noticed it the very first trading day of December 2nd. So we're looking at the NASDAQ 100 and the equal weight S&P 500. So you've got 7 stocks in the S&P 500, the mega caps, the Magnificent Seven, that are responsible for half of the gains in 2024. And what we saw in December was window dressing. So it was the art of looking smart. And I'll explain that real quick. So if you have a hedge fund and say it didn't even do very well this year, you were in the wrong stuff, which, the right stuff was the mega caps and the AI stocks in the first half of the year, you can buy these stocks at the end of the year before December runs out. And they are on the books. And when you go to present your prospectus to new clients in the new year, it shows that you owned all the right stocks. And they look at it and said, oh, wow, you owned all the Magnificent Seven stocks. They did great last year, even if you only owned them the last couple of weeks of the year. But that's why they call it window dressing, the art of looking smart. But if you see the equal weighted S&P 500, which strips out the weight of those Mag 7 stocks, pretty much everything else was selling off. So it's kind of like sell everything, buy the mega caps, window dressing. See the exact same thing here if we look at the NASDAQ 100 as of December 2nd and the Dow Industrial Average. As a matter of fact, if we look at the Dow Industrial Average and right here around December 2nd, we see 11 consecutive days or 10 consecutive days of selling. It was the longest losing streak for the Dow since 1974. Small caps versus the NASDAQ. Here's that outperformance in the election. So it really did favor these small caps, mid caps, cyclicals, value, everything that really hasn't done as well this year, and NASDAQ kind of underperformed. So we can see that here at the election, but then as we get into December, again, you can see the small caps underperforming. And if we look at the daily chart on those, there's the election, the knee-jerk response to the election. Small caps did the best that week of the election, and then into December, here's the second, just kind of selling all the way down. By the way, this is the FOMC rate cut, but hawkish rate cut. And even the S&P 500 underperformed the NASDAQ 100 into December here, December 2nd. NASDAQ is tech heavier, so while it is a cap-weighted index, the benchmark S&P 500, it's not as sensitive as the NASDAQ 100 is to those mega-cap tech stocks. Then we get the mid-December FOMC, the Fed's interest rate decision, which also came with the summary of economic projections, which includes the dot plot, and you see just everything sell off. So S&P 500, NASDAQ, Dow, small caps, everything sell off on what was basically a hawkish rate cut. The reason it was hawkish is because 2025 and 2026 rate cut expectations were slashed in half. The reason being is inflation stalled. The progress on inflation stalled in September when the Fed first cut by 50 basis points. And here's just a quick overview of small caps soaring on the election, kind of the pro-growth Trump policies and enthusiasm over those, and then that whole change in character into December, which was about window dressing, making everything look good for the next year, 2025, and then the FOMC here, really just knocking everything down and disappointing the market, which is partly why we're off to a much rougher start. If you remember, coming into 2024, the market was pricing in 7 rate cuts in December of 2023. And they were expecting them to start in March of 2024. We didn't get our first one until September. We did get 3 rate cuts instead of 7. Looking at the NASDAQ 100's perspective, there's the window dressing, September 2nd, just a real pickup. This channel, this is what I call a channel buster. It's kind of just like, I did a 60-second video. It's in my my videos. It's called the channel buster. And generally speaking, when you have this nice clean channel and then you get a kind of a breakout that fails, it usually reverses real fast. This works both ways in uptrend or a downtrend. So channel buster back tested that into year end. What that allowed, though, was for hedge funds and all the other window dressers to get pretty close to the highs of the year and kind of retrace a lot of that FOMC gain. And then as we get into the new year, what we can start seeing is lower highs, lower lows, or what's becoming a sub-intermediate downtrend, an orderly one, but still a change in character. Here's the NASDAQ 100. I've put red circles around the pivots so you can see lower highs, lower lows. So we're getting into that sub-intermediate downtrend. Not too aggressive, not like a sharp sell-off. Kind of reminds me a little bit of the summer of 2023 when the S&P lost about 500 points over 3 months. Very orderly decline, no big crashes in it. But we would see stuff like this, these big bounces and then a new lower low and a bounce to a lower high and then a decline to a lower low. So if we go back to this chart of IWM small caps, we can kind of just summarize the end of the year here with the election enthusiasm over Trump policies, deregulation, all that stuff, pro-growth policies. I don't want to get too much into that because I think some of the policies do clash. But then we could see the window dressing trend, which was a completely different feel than what we saw over here. Hope in growth. Over here, window dressing is just kind of about Wall Street taking care of itself. And then the FOMC or the Fed really shocking or disappointing markets with a much more hawkish December rate cut of 25 basis points. But it looks like they're going to be on pause for a while again because inflation or progress on inflation has stalled as of September. Speaking of that, we're looking at the 10-year yield. So the Fed cut right here. That was the first rate cut in September, and they have cut 100 basis points since then. 10-year yield has risen over 100 basis points. So generally, when the Fed cuts interest rates, you'll see yields move with the Fed's Fed funds rate. They'll move lower. Instead, what we're seeing is the bond market kind of almost rebuke the Fed and say, policy mistake, you cut by 100, we're going to lift this by 100. And notice when, September, when progress on inflation stalled. This is a really important chart. One of the reasons we're having a more challenging start to the year is stocks don't like higher rates. I mean, that's what we saw in 2022's bear market. The Fed started hiking rates and stocks, their valuations got hit. Small caps especially don't like it, but when you go up high enough in rates, mega caps get hit too. Generally speaking, if you see a rise in rates of about 60 basis points in 1 month, you get this kind of VAR shock and a sell-off. We saw that in October of 2018 to December of 2018 in two legs down, about a 20% loss in the S&P as the Fed was hiking rates, and we saw this VAR shock. There's also an old Wall Street maxim. I don't want you to take it as a rule of thumb because it's really not. It's really just kind of an old Wall Street saying, which is sell the third Fed rate cut. And in addition to that, we've seen a 63 basis point rise in 10-year in 23 days, so not even 30 days. So it's becoming a more challenging environment for stocks with rates rising because we're not seeing, inflation like or reflation like the early 1980s, but we are seeing a bounce in inflation. To illustrate that, here is the NASDAQ 100 futures in the candlesticks and the 10-year yield, but I've inverted it. So as it moves lower here in blue, that's actually higher yields. And over here, you can see that H1 2024 bounce in inflation, which we forecast. And then over here, you can see yields starting to move higher and stocks coming down. Over here, yields are coming down as we're making progress on inflation, and here's the bounce, and now we're starting to see a little bit of trouble in stocks over here, or at least a lot more choppiness. Like I said, pretty much everything changed in September. That was the first Fed rate cut. While the Fed didn't have so much in the way of economic data to really let them know that progress on inflation was stalling, you could see it in a lot of other places, commodities. So that's why a lot of my analysis is not technical with like MACD and RSI and stuff like that, but I'm looking at cross-asset analysis. So I'm looking at yields and currencies and commodities and how they react with the stock market. So if we go over to the CRB index, the commodity index, over here you can see disinflation, and September a bump in inflation. The US dollar index, which is reflecting both that bounce in inflation here, September, you can see the end of September, and also reflecting the more hawkish Fed rate stance from what we got in December. But the market was picking up on this. Parts of the market, anyway, were picking up on this bounce in inflation well before the Fed, well before the stock market. So commodities, rates, currencies, they are the smart money. They're the bigger markets. They get these things first. The stock market doesn't get it until it's like hammered over the head with it. So like the COVID crisis, we saw rates and commodities and yields just plunging. Commodity-related currencies like the Australian dollar were just screaming that there was a deflationary spiral coming up, and stocks were trading at all-time new highs. This deflationary spiral, all these signals we were getting were about 5 weeks before it actually manifested, which was the COVID shutdown in the United States. But the point is, all these other asset classes had picked up on it about 5 weeks before, while stocks were making all-time new highs and just completely oblivious to it. So stocks last to get the message. So we've seen commodities rise since September. We've seen the dollar rise since September. And here's the 10-year yield. This is the first Fed rate cut of 50 basis points. Fed has cut 100 basis points, and 10-year yield has risen over 100 basis points since then. If we look at the 2-day chart of the 10-year yield, you see this almost kind of bullish. This is disinflationary progress over here, but it's still a big kind of bullish pattern. In stocks, I wouldn't call it a bullish pattern, but in commodities and rates that tend to trend better, these larger patterns are valid. Over here in 2021, stock market was making all-time new highs into December 2021 and very early January 2022. We see a breakout in yields, and this is the equity bear market of 2022 as yields rise. Now we have this big bullish pattern, and again, a breakout in yields. Here's September, the Fed's 50 basis point cut right there, and yields breaking out again. So not a great thing for stocks. Here's that same chart that I showed you before of NASDAQ 100 futures and the 10-year yield inverted. So that means when this blue line moves lower, yields are moving higher. So this is the all-time high of 2021, early 2022. You can already see yields moving higher into that in preparation for Fed rate hikes, which started in March of that year. And yields move higher. You can see stocks move lower. I use NASDAQ here because mega caps were the most hated stocks of that bear market. They had very high valuations, and higher yields demanded that those valuations be marked down. Now, while we've seen a bounce in commodities and inflation, since September of this past year, 2024. Oil is really one of the biggest ones. I mean, it flows to everything. So whether it's like making plastic for Coke bottles and food, or whether it's, gas in your car, oil is a very inflationary or disinflationary asset, has a lot of influence. So we're going to take a look at that because we've been watching oil very closely, even if we're not interested in trading it, because there's been a lot of periods where it's been very choppy and not very interesting. But as far as what yields are going to do, what the Fed's going to do, how that affects the stock market, oil is very, very important. And what we saw with oil was this is the disinflationary downtrend from the first half of 2024. This red line saw a lot of chop, just messy action in oil, and then this triangle started to form. Got a breakout, got a whole bunch of back tests that it held. I said like 71 and then 74 were the key areas where we start to get some momentum to the upside as shorts start to cover, CTAs start to go long, and we see a breakout really in crude oil here above that downtrend line, which is very important. This is very recent, this past week over here above 74. That means that we are going to see higher rates. Here is the big picture daily chart of WTI crude futures. This is the first half of 2024 inflation bump, or kind of like a little bounce. Exactly the reason the Fed could not cut in March, exactly the reason the Fed didn't cut 7 times in 2024, because of this. Here is progress on inflation or disinflation as oil prices come down. And you can see why the Fed felt safe with going with a 50 basis point rate cut in September. Here's our triangle, here's our breakout, and we're breaking out above this kind of longer term disinflationary trend line, getting into a more inflationary stance. This is going to make things harder for the Fed. So they're already pretty much on pause. Whether that's been explicitly communicated or not, the market understands. The market isn't pricing in the first full rate cut in 2024 right now until October. That's going to change a lot. It's going to move around a lot, but that just goes to show how much things have changed from going from 4 rate cuts in 2025 to 2 as of the December Fed, and now like the first one's not even being priced in until October. What I've noticed over the years of observation is oil prices tend to lead the 10-year yield. So if we look at the 10-year yield in candlesticks and USO for oil in blue over here, see some weakness in oil over here, and yields come down. We see some relative strength in oil. Yields move up. We get a bullish consolidation here, a breakout, another big bullish consolidation. And this is that recent run above 71, 74 in WTI crude and the breakout, and we see a breakout in yields. So the market seemed to be okay with yields as long as the 10-year was between like 4.40 and 4.5% over here. But since we've gone over like 4.5% in the 10-year, things have gotten more shaky. We've seen mega caps come down, small caps come down, pretty much everything come down once we got past that kind of self-serving window dressing for hedge funds of December right into the end of the year. And here is a daily chart with a big picture of the same thing, the 10-year yield and USO or oil in blue, relative negative divergence in oil. That's a pivot down for yields, relative positive divergence over here. It's a pivot up, pivot down, pivot up, and we can see yields are starting to be led higher by higher oil prices. And that's partly what's leading to what we're seeing here in the S&P 500. So window dressing as of, well, December 2nd, it was very obvious, but coming into December. So led by the NASDAQ 100, and then here's the FOMC, hawkish. But since then, we're getting lower lows, lower highs in the S&P 500 too. Not a crash, an orderly kind of decline. But still, it is a major change in character, and as I always say, changes in character precede changes in trends. It's very rare that you'll see the market just do something crazy, like just go from a downtrend to an uptrend or an uptrend to a downtrend without there having been a change in character. They're just more subtle. You have to look for them. That's one of the reasons that I look at commodities and currencies and rates, because those markets tend to get it. They're less emotional. They start reflecting it well before stocks do. Again, the NASDAQ 100 with that window dressing trend, the Fed, the channel buster up here, lower lows, lower highs. So an orderly decline, but still a downtrend. And being that mega caps have really been the only game in like the first half of December, we really didn't see cyclicals or small caps or the Dow do very well. So we're seeing some worse looking charts there. So we have this area of potential support. We'll talk a little bit more about this in a second. In NASDAQ 100 around 20,800. But if you look at the Dow, very different picture. So this is the same time frame, same time period. We have a bullish consolidation that failed to even try to break out. This is that trend of sell everything, buy mega caps in the first half of December. Here's the FOMC. Here is a bearish descending triangle. So this is a consolidation continuation pattern. Continuation, meaning this is first leg down, and we're just starting to see a break this past week of this consolidation, a little back test there. So former support is becoming resistance, and this is really the most tricky spot for any kind of consolidation, whether it's like a breakout right here or a breakdown right here. This is where they're most susceptible to a failure of that pattern. Unless you get a really decisive move, like sharply lower, it's a difficult area. So this is what we're going to be watching in the next week here. Small caps, same kind of thing. We see sell everything in December, buy mega caps, FOMC, a bear flag, and this past week, a break of that bear flag. Not a strong impulsive move lower like we saw here. So it's a dangerous spot as far as this bear flag breaking down, but this is not a good sign. It's not a good looking chart whatsoever, but it still is in that kind of tricky, dangerous spot for this breakdown or this second leg down. If that second leg down does hold, we're going to see some much worse price action in coming days and weeks. 3C charts have been just on point. That's my proprietary money flow indicator. They've been on point. You can see SPY over here, 1 minute 3C chart, which is the most sensitive time frame, trending down from December, the end of December into January. So even when the market bounces, 3C is not confirming. It just keeps trending down, and those bounces fail. They become lower highs, and then we get lower lows. Over here, flattening out just a teeny bit. I wouldn't call this a big change in character, but it's going to be important as we move into next week. Here's the diamonds, the ETF for the Dow. Same thing. 3C is just trending lower, leading price lower. It's been trending lower. It's still trending lower. This is where we have that bearish consolidation that just broke down the end of last week. Not a lot of improvement over here. And here's IWM with a bear flag. So what 3C generally does, coming into a bear flag, it will positively diverge just a little, and then it'll usually kind of track with the bear flag. As the bear flag matures, you'll see money start flowing out in that pattern, start deteriorating. This is the end of the bear flag over here. This is the breakdown that I just showed you just below the bear flag. 3C again, trending lower. And here's QQQ, the one chart of some interest. So 3C trending lower from the end of December, the second half of December after the FOMC meeting into the new year. You can see bounces not confirmed by 3C, lower highs. Another bounce, not confirmed, lower high. We are getting a slight relative positive divergence. This isn't something I would like jump up and down and say, okay, we're ready for a bounce. But it's definitely something that we're watching very closely. So beyond the lower highs, lower low trend, so we have a downtrend here. It's modest, it's not a crash or anything like that. It's orderly selling. The area I'm kind of watching in the NASDAQ 100 is about this 20,800 level. So price held above it on the close. It did trade low enough intraday on Friday to make a lower low. If we see this 2,800 level hold and we start seeing some more buying, so like another test of this level, we have like a test here, we have a little lower low, but a successful test on a daily time frame. Maybe we get another test and 3C starts picking up a little bit. We'll look for a bounce and gap fills. Right over here, we have a gap. In some of the other averages, we have some other gaps that are unfilled. I think probabilities are that it would be a tradable bounce, but I also think probabilities are that it would be to another lower high within this kind of developing sub-intermediate downtrend into the new year. We have a similar level with the S&P 500, even though we did make lower lows, lower highs. It's right around 58.30, 58.35 in that area. I never look at support and resistance as an exact level. I look at it as an area. So we closed just under it, but still, we'll look into next week, see if there's any improvement in those short-term 3C charts, suggesting, that maybe we fill some of these gaps, like right up here, and bounce to a lower high. And that would be a place where, again, you could trade this on the long side for like a quick swing trade, and then again down to the short side as we make a lower high, unless anything changes. But I think we are starting to see a little bit more of a troublesome environment with rates and inflation kind of picking up, especially now that crude is doing better and it's really breaking out of that mess, that lateral mess, and that disinflationary trend line. So as we head into next week and the week after, what we're kind of watching is whether or not we see any changes in character in these 3C charts. This is RSP, which is the ETF for the equal weight S&P 500. You can see the negative divergence into the end of November, coming into December, and then just leading lower. So this is a 3-minute. If we go to the 1 minute, it's a little bit more sensitive. So we do have a change of character, even though it's been trending down. 3C's been trending down. It goes flat over here and slight positive divergence, very small still, like QQQ, but this is what we're going to be watching into next week as we watch those key levels like NASDAQ 20,800. When I talked about Stranger Signals video I did in July, ahead of that July sell-off in tech, we're starting to see some of those signals manifest too. So one of them was this indicator that I use, the absolute breadth index, and a particular reading on that tells us a very, very high probability chance that volatility is going to surge, like a massive surge. And we're starting to get one of those signals. So here it is up at 55. I think that's like mid-December, Christmas Eve. 55. No signal there at 55, not important at all. But when it gets down below 14, that's when we get our signal on a closing basis. And we have seen this very, very sharp drop in the ABI. So I don't know if we'll get to the signal, but more often than not, what we do see is before a signal, we see sharp drops like this. So as we go into the coming weeks, we're going to be watching this too, because if we get one of these, it's going to be telling us that something really nasty, other than kind of a sub-intermediate orderly decline, is coming. In any case, I think that's a pretty good overview to start the new year from, and then we'll kind of just build on that. If you liked the video, please give it a thumbs up. If you haven't subscribed to my videos, please think about subscribing, enable notifications so you know when a new video comes out. And if you want all this information on a real-time basis, every day the stock market is open. I'm doing this in real time. Check out Wolf on Wall Street Trade and our new website opening up, thetechnicaltake.net.